Hello, and welcome to the Logistics Management Podcast Series. My name is Jeff Berman. I'm Group News Editor for Logistics Management Magazine and the Peerless Media Supply Chain Group. Today, it's a real pleasure to welcome Lee Klaskow to our podcast. Lee is a Senior Global Transportation and Logistics Analyst and also Sector Head for Bloomberg Intelligence, a division of Bloomberg LP. Lee has been analyzing the freight markets for decision makers going back to 2006. His current coverage spans global marine shipping, air freight, and logistics sectors, as well as the North American trucking and railroad industries. In addition to his industry work, Lee provides coverage on 21 freight transportation and logistics companies. He's focused on providing differentiated research through channel checks and collaborating with colleagues in adjacent industries. Lee's an articulate public speaker and frequent contributor on Bloomberg television and radio, as well as other media outlets. He also speaks at industry conferences, as well as company and academic events. Prior to joining Bloomberg, Lee was a senior analyst at Longbow Research and Prudential Equity Group, where he covered freight, transportation, and logistics companies. He was ranked 4 stars by StarMind for EPS accuracy and recommendation performance prior to joining Bloomberg. Lee earned his Bachelor of Science degree in Finance and Management from Ithaca College and holds a Master's in Business from Fordham University. Lee, welcome to our podcast.
Thanks so much for having me, Jeff. Really appreciate it. And I guess next time I should have my elongated bio for you.
Okay, all right. Well, no, it is great to have you. And the timing is good, Lee. There's obviously a ton of stuff cooking within the sectors that we both follow and cover. Why don't we start at a top level, Lee? And that just has to do with sort of the overall freight economy. When we look at what's happening, it's obviously been a wild ride going back to the onset of the pandemic back in March 2020. But we are seeing some signs of more normalcy afoot here. So when we look at the freight economy, that's an all-encompassing question that could probably take up all of our time. But when we look at it through the lens of the shipper, the things that are important that they're keeping an eye on, whether it's inflation, gas prices, retail sales output, things like that, I'll hand the mic to you and we can go from there.
Okay, great, Jeff. Well, I mean, so I cover pretty much all modes of transportation as it relates to freight. So, ocean, air, road, rail. And, we're pretty lucky at Bloomberg. We have a lot of data at our fingertips on the Bloomberg terminal. And
Right.
kind of reading all the tea leaves that we see, what we see is an economy that's moderating, a consumer that is, I'm not going to say they're weakening, but they're being more selective on what they spend their money on, and households that have pretty good balance sheets relative to where they were prior to when the pandemic started. But the reality is we have tough comparisons from last year. We also have, moderating economic growth, and then we also have inflationary pressures, and that's just increasing the probability of an a recession next year. Consensus estimates on, at least on the Bloomberg terminal, put that probability of around 63% that the U.S. economy is going to go into a recession over the next 12 months. And, that has up considerably over the last, 3 to 6 months, where people are getting a little more pessimistic. And, we're seeing it in retail sales. They've been disappointing. At least some retailers have shown some disappointing sales. And also, you saw the ISM for November go below 50, which indicates that the manufacturing economy in the United States is contracting.
Yeah.
And then when you follow that data along, we see information from, LTL carriers like Old Dominion. They, and along with some of their peers, provide monthly volume statistics, and their tonnage fell just under 9% on about 7% fewer shipments, and so you're seeing that weakness in the industrial economy, and we're also seeing that weakness in the industrial economy when it comes to rail traffic. Rail traffic, what we call commodity carloads, which pretty much is everything but intermodal, it's pretty much flat this year, and it's being driven by weaker forest products and metals. which is being offset by, stronger automotive markets. And as of late, ag has come on, but still year to date, it's down about 4%. And then, finally, when we'll pivot back to the retail, the health of the consumer and the retailer, as I was mentioning, average households have more cash savings than they did prior to the pandemic. But the reality is, people are getting a little concerned as more and more companies are announcing layoffs. You need to obviously save for a rainy day, and you're seeing that information, kind of like I said, in some of the retail numbers that have been coming out as of late. But next year is going to be, we're really not focused on what was. We want to focus on what we expect will be. And obviously, our crystal ball is as foggy and as cracked as the next person.
Sure.
But we like to take a look at where we think things are going. And from our vantage point, it looks like rail traffic is going to be mostly flat next year. You have strong ag and automotive carloads, which will be, probably offset by, slightly down intermodal. Intermodal it's an interesting beast. Not only is it driven by retail and e-commerce, but it's also, driven by, what's going on in the spot market of trucking. And as, many people have known, or have noticed as of late, the spot market is in a rebalancing period. There was a lot of demand for spot capacity, 6-8 months ago, and that demand has waned pretty considerably because of these economic headwinds that we were talking about, and that's driving rates down considerably because there's just a big imbalance with supply and demand. And we expect more owner operators or small players that play in the spot market to slowly leave the market, and we could see that market look better probably the latter half of 2Q or early 3Q.
Okay.
And so those pressures makes moving something by truck maybe a little more attractive for a shipper, because the costs are the discount that rails provide from a dollar standpoint is not as high because of where they can get it in the truckload spot market. And intermodal's fantastic service, in terms of you can lower your carbon footprint, which is extremely important to a lot of shippers, and it's becoming increasingly more important as ESG standards become important to investors. And so if investors are looking at these environmental benchmarks, the shippers want to make sure that they look good from an ESG standpoint, and intermodal is a key way for shippers to kind of lower their overall carbon footprint. But the rail's ability to win more share from the trucking market over time has been hurt by their inability to properly resource their networks.
Yeah.
The rails dealt with what a lot of industries dealt with during the pandemic, where labor shortages. They furloughed a lot of their workers, their train and engine workers. They furloughed probably too many when the slowdown happened, because it happened pretty quickly. But what happened even quicker was the rebound. And when they were calling back their employees, call it like in normal times, maybe 50 to 60% of the folks would come back to work. They were finding that was much lower, and people were like, well, that staying home is kind of nice, because workers that work on the rails, it's a difficult job. It's obviously outdoors. They're not home every night. Not every person that works on a railroad gets to go home every night. And they sometimes miss family events. And what the pandemic, at least for me, like I got to have dinner with my family every night, which which was really nice. I have young kids, and so it's nice to do that and to have that flexibility. And so you saw them kind of scrambling to find workers, and they're kind of at I would say the late innings of properly resourcing their network. And that is probably more emblematic of the US based rails, more so than the Canadian-based rails.
Yeah, no, those are some great points to be sure, Lee. And I do, speaking of the rails last week, sort of a crisis averted, if you will, as it relates to there was the impasse between the United States freight rails and the 12 labor unions, with the remaining unions kind of holding out, if you will. We'll table that for a minute because it is an interesting and timely topic. But I did want to address peak season with you. Peak season, as we had traditionally viewed it, was kind of the build up to the holiday season, the cargo coming in, most freight being in by, say, August to United States ports. The pandemic obviously changed that. There was a working thesis for a while that it was peak season year round, especially due to the demand-driven e-commerce push that we all saw when we were all out buying Pelotons and stuff for our homes and what have you. So I guess that's sort of just a lead up to how do you view peak season now in 2022? A lot of people seem to think that it was really a non-event, and you can see a lot of supporting reasons as to why. I'm just wondering how you guys at Bloomberg are viewing what did or did not happen as it pertains to the 2022 peak season.
Yeah, heading into the peak season, our expectations that it would be pretty muted. It was probably even more muted than we probably originally thought. Some of that has to do with some of the issues facing consumers today, is people wanting to save more and spend less on stuff because of uncertainty over their own employment. And then
Yeah.
also there is, obviously the switch that we've all, seen and probably experienced firsthand. People are going back on vacation, going to movies. So instead of buying stuff, they're doing things. And so that's a big contributor to it as well. And also, retailers, at least not all retailers, but a lot of retailers had high inventory levels already. And so, they were probably being more selective on what they were bringing on board, in terms of additional products, outside of obviously the truly seasonal stuff. And so, that had an impact as well. And then, we'd be remiss if we didn't mention that, the comparisons are pretty darn tough because last year was a pretty good year for the holidays.
Absolutely. And taking that just a step further, do you think that the return, Lee, to a more traditional return to the services-based economy, I mean, that certainly has had a meaningful impact on freight movements as we're all back out in the world, going to baseball games, going to the movies, going on vacations, traveling, etc. That takes away from those disposable dollars that had been allocated, to what we saw early on in the pandemic, buying physical goods, buying exercise equipment, buying stuff for your back deck, etc. Are we sort of at I don't want to say an inflection point, but that's sort of, I mean, everyone was inside for so long. There was obviously a fair amount of pent up demand. That would appear to be a more traditional trajectory, and that's where we are now, right? I mean, so do you think the markets have adjusted accordingly, given the adjustment back from a goods to a services based shift?
Yeah, so what I would say, the markets, and I'm assuming you're talking about the freight markets.
Yeah, yes, I should have been more clear. Exactly. Yes.
Some are ongoing, and some it really doesn't matter. So when I say ongoing, so you hear about FedEx, canceling flights, and
Yeah.
some of that has to do with the limited amount of stuff coming out of China and Asia in general. The China stuff is obviously due to those prolonged lockdowns that we've been hearing about. They've been lifting some of the restrictions as of late, but at the end of the day, their economy is extremely constrained because of the policies that they still have in place. And so so the air freight world is actively adjusting their network. We mentioned earlier the spot trucking market. We're seeing that shift, week in and week out. When you're talking to the large publicly traded trucking companies that we cover here at Bloomberg Intelligence, they're not they're not making a capacity switch, because when they grow, unless we're talking about their dedicated truckload businesses,
Uh-huh.
their over the road businesses, they're really not looking to grow them like very fast. They might like add a little capacity here and there. When they're looking to grow those businesses, they're looking to do it in a more asset light manner. And so they would rather either work with owner operators or, fill that demand through their, freight brokerage units, which, a lot of these large publicly traded companies like, the JB Hunts, the Warners, the Knight Swifts of the world, they have these multi-pronged businesses that can, that can easily, their capacity can easily change with demand because of that, shift towards a more asset light model. I mean, obviously, their over the road trucking fleets, very asset based. They have trucking, they have trucks, they have people, but, when you're looking to grow, it really makes a lot of sense, especially given that, the trucking cycles are getting they seem to be getting more volatile and shorter. Where trucking cycles used to last 5 years, they seem to last 18 to 24 months now.
Yeah.
And so it just doesn't make sense for a trucking company to buy 1,000 new trucks for the upswing, because in 24 months they may not be able to seat those trucks because there's no demand for them.
Yeah, no question about it. Um, let's jump back to the recently crisis averted, if you will, on the rails, Lee. I can't remember aside from, I guess, the pandemic, if you will, but I can't remember a more supply chain oriented theme getting as much national attention, mainstream media attention, if you will, than this recent situation. It was it definitely had everyone's eye and ear, if you will. I guess the outcome that we got, is what people were looking for. Although there had been indications that if a strike were to occur, it would have been for a fairly short duration. I heard people say that it could have been maybe a few hours or even just a day or two. Duration aside, it raised the antenna of a lot of people and brought about a lot of concern. How do you sort of view what happened and sort of what happens now? Obviously a deal is in place, that's a good thing, but it definitely leads us to some overall concerns, especially coupled with some service issues, service challenges on the rails still ongoing.
Yeah, so labor is obviously an important part for the railroads, and having good relationships with their unions is important. It seems that like during this negotiation, the unions were in a position of power, just given the resource issues we talked about earlier, in terms of the rail still trying to find enough people to work. And they got in terms of from a financial standpoint, they got a pretty good contract. It was 5 years, which included around a 24% raise and
Yes.
some one-time bonuses. Where they didn't reach an agreement on was on sick leave and how sick time works, because a worker, if they have to take a sick day, go to a doctor or something like that, sometimes they get penalized if they do it last minute. And it's just a way for the railroads to kind of, I guess, resource the network for that day. I think a couple of things might come of this. I think that the rails will tell you that they don't want to do it from this national contract. This is just something that's usually negotiated on the local level.
Yeah.
So I think we're obviously going to see that negotiated on the local level. And I also think that railroads, at least the ones that are going to probably be better at providing service, are probably going to end up running a little fatter than they have in the past. I think that the myopic focus on an operating ratio is gone. If it isn't, it should be gone. And more and more rails should be focusing on profits are important because they have shareholders to contend with, but profitable growth versus just getting that operating ratio down as close to 50 as you possibly can. And some of those, like when I say fatter, I'm not saying that they're going to have more corporate jets. I'm talking about maybe they're just going to have to have more people available to work, and
Yeah.
pay for those people's time. And I think that's what's what come of this. Obviously the rail industry is extremely important, not only for the U.S. economy, it's important for the global economy. It's how people get goods, it's how people get food. The trade group, AAR, put it at $2 billion a day, that if they struck, that's what it would cost the economy. Maybe give that a haircut to 1 to 1.5 billion. But it's
Sure.
still a lot more than I make, that's for sure. And no, it's still pretty pretty significant, no matter how you look at it. It's good that a strike was averted, but I think there's more work to be done between the unions and the rail operators, to come to a place where it's fair for both sides. And
Yeah.
I as someone who works at an ivory tower, and I can see both sides, their view on this. But
Mhm.
I really think that they can come together versus having something forced to the rails. The agreement that they did have was actually more favorable for the unions than the rails probably wanted, in terms of how much they were increasing their pay and
Yeah.
their bonuses. So I think there's just more to come on this. But obviously it did impact some freight. Some freight was probably diverted to other modes. You had hazardous material that probably couldn't be taken on by the rails because of the regulations around hazardous materials. And so now that the strike was averted, I guess that was last week. You're just seeing more normalized freight flows, which is good, not only for the rails, but it's also good for the U.S. economy, which
Right.
is like I was saying earlier, is really at a point, and it's extremely fragile. And any recession, it will probably be short and shallow, which we can call a Lee Klaskow recession.
Yeah.
If a strike happened, it would probably have an impact of possibly creating a longer duration for a recession and a deeper recession.
Yeah, no question. And I know the recession talk is obviously prevalent in both supply chain and mainstream economic circles, to be sure. At least it's got to be at least somewhat encouraging that while everyone is of the school of thought that a recession is likely to happen at some point, at least there are some signs, Lee, and correct me if I'm wrong, but there are at least some inklings that inflation is trending down somewhat, as are diesel prices, especially in recent weeks. So, I mean, I guess you sort of just have to take the tailwinds here as it relates to that stuff when you can. Are you seeing that in a material way at all within the markets you cover? Are you hearing anything from the publicly traded companies on those fronts?
Um, the reality is, when it comes to inflation, they're all facing inflationary pressures. And they're not gonna talk about, oh, inflation is maybe it peaked a couple of months ago in terms of the year-over-year increase, and that year-over-year increase has been moderating over the last couple of months. They're just seeing higher costs. They're seeing higher costs for equipment. They're seeing relatively high costs for fuel, even though to your point, diesel prices have gone down pretty nicely over
Yeah.
the last couple of weeks. And so that's obviously a good thing, especially for the trucking industry. But like there's still when you talk about, when we're talking to our, friends on the trucking side, they're still having problems getting new trucks. The OEMs are kind of dealing with supply chain constraints and a backlog. And trucking companies tend to like to refresh their trucks pretty often. They like to have a younger fleet under 3 years, at least the large carriers do, because anything over 3 years, the maintenance costs tend to be higher. And then also, your reliability goes down. And then, not only does your reliability go down, but also, it's a good way to attract drivers and keep drivers that are able to drive, like, the newest kind of trucks that are out there. And so, we're hearing, whether it's trailers or trucks, they're all having, issues getting them, and they're all more expensive than they once were. And, if we're going to stick on trucking, they're also dealing with higher insurance costs, higher labor costs. So, I think inflation is here for a while.
Yeah.
Hopefully what the Fed is doing, will tamp it down to a more manageable number. But, I think that the a world of, 0 to 2% inflation is probably, we're probably not going to see that for a very long time, where, maybe, inflation around 3 or 4, might be the new norm, once we come off these, the current cycle that we're
Yeah.
currently in.
That would certainly beat 7 or 8.
Yes.
To be sure. All right. Well, listen, Lee, this has been great. This brings us to the end of our allotted time for today's podcast recording. On behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, I just want to offer up a big thanks for joining us today, spending some time with us.
My pleasure. Thanks for having me, Jeff.
Yeah, no problem. And for those of you in the audience that are on Twitter, please go ahead and give Lee a follow. It's simply at Logistics Lee. Lee also has a very good presence on LinkedIn as well, so look for him over there as well. And spell his last name Klaskow, for those that were not sure. And also, please feel free to give us a follow on Twitter, Logistics Management, that is, simply at Logistics MGMT. And for those of you that are not subscribing to the podcast but would like to, just please go ahead and look for Supply Chain 24/7 wherever you get your podcast, and it will pop right up. So thanks, everybody. Have a great day, and we'll see you next time. Thanks again.